Hey, and welcome back to a new video. Today I want to talk about a little reversal topic that I think can make a big impact in your trading if you can understand it, because I see so many traders making the same mistakes over and over again, and this could be very easily corrected if you just pay attention to this one little pattern. So as you all probably know, if you've been following my YouTube and my site for a while, I'm trading reversals, so I look for those transitioning periods when we go from uptrend to downtrend and from downtrend to uptrend. And this is the only thing that I trade. I only specialize in finding those transitioning periods that then lead into new trends. And the biggest problem that I always see in all traders is when they start out reversal trading is that they don't wait for the reversal to happen, but they try to pick the absolute top and the absolute bottom almost or in all cases. So this means that when you see this uptrend here, they don't wait for this to happen to short, but they will short around here, then they will short here, then they will short a little bit more here, and then price goes against them until they are in a loss. Then they exit their position, and then of course what happens, price goes in their favor, but they are not in this trade anymore. And then what happens again? Then they see the trend is going down and they think that it has to go up again. So what they do is, again, they will buy here, they will buy here, here, and then price goes against them until they're in a very big loss. They exit their loss, and what happens? Price again goes in their favor and goes to their actual take profit target without them. And this creates a lot of frustration, and this eventually then leads to a lot of account blow-ups and many problems that I see almost every day when I talk and work with other traders. So the first thing is that you have to understand you don't have to pick the top and the absolute bottom when you're reversal trading. You only take what is safe in between. So when we look at this, you see that price is going up, but you're not going to sell here, or you're not trying to pick this top here. But in this case we use the 20 period moving average, which is this signal, this line here you can see in gray, and we only trade once price breaks this moving average. So in this case you can see price is going up. It was all the time above the moving average, which means that we are not going to sell. But then here we broke the moving average and price started this new trend. So, and then there are two ways to enter such a reversal trade. The first and the more aggressive one is you sell directly on the break of the moving average, but this will lead to a lot of losing trades, because you can see that not all time when price breaks the moving average we get the new trend, but often we just get the reversal and you will be in a losing position. So the most safe entry that I usually take is the break of the moving average and then the close of the candle. So in this case you see price broke the moving average, we closed below the moving average quite some distance away. This is also very important, because you don't just want a little candle that just barely breaks the moving average. This is not a strong enough signal. But you want a large candle that shows that sellers are now in control, and you want to go far away from the moving average. So when you compare to here, we broke the moving average, but just barely broke it, so this is not a good signal. Here as well, and those are all fake signals. That, as you can see, price went back up above the moving average, whereas here we broke very far again, and this led then into a new downtrend. So here are two critical lessons that you have to understand. First, you're not trying to call this top, and this top. Although you would get much larger profits if you were able to sell around here, this is not how reversal trading works, and this is just predicting market turns, and this is a very amateur way of trading. But when it comes to professional reversal trading, we look for exact clues that we are already in a new trend. So instead of selling here and getting a lot of false trades and a lot of losses, we only sell here, or maybe here if you're more aggressive. And we only take what is safe in between. This way we can avoid a lot of mistakes and a lot of losing trades. Also, this way of trading is much easier on your psychology and your emotional capital, because it puts you in a reactive state of mind where you don't try to predict what has happened, but you just see the price is already making new lows and it has completed the trend, and you're only taking the safe pips in between. And those are a few very important concepts and topics when it comes to reversal trading. And this also applies to trend following, where you don't try to pick the absolute start of a trend, but you wait for the trend to be established already. And you also don't pick the absolute end of the trend, but you get out before the price runs into a market top and just take what is safe in between. And when it comes to reversal trading, I always recommend using the 20 period SMA as your filter criteria. It's such an easy tool and sounds so simple, but it will make a huge difference in your trading if you can just start listening to the 20 SMA and only trade in this direction of the 20 SMA. I hope this helps, and let me know if you have any questions.